Okay, good morning and welcome everyone to MACROACE with your host Tony. I'm also the head financial analyst at FinancialJuice. Inflation data going to be key before the Fed's meeting tomorrow in the afternoon. So let's get into it. I'm running a little bit late, so let's go through some of the stuff here. First of all, what is CPI? It measures how much consumers are paying for retail goods and services. And the way it's measured, you have 26,000 retail outlets, 4,000 housing units in 87 urban areas where prices are collected on 80,000 different goods and services. So the key measurements then, how it's broken down, what are the different weightings? You have housing, which represents about 42%, food and beverages about 14%, transportation have about 18%, and medical care about 8.5%. And then, of course, you have the core CPI data, which excludes food and energy, usually seen as a more reliable gauge of what inflation is like within the US and also other nations too. But in this case, all bits of data for inflation still matter, regardless of whether it's core or the normal headline inflation data. And then usually the seasonally adjusted is preferred as to what's going on in the economy. And that's the month-on-month figure because it shows how the economy is in regards to inflation without the effects of weather and production cycles and so on. Then the difference between PCE and CPI, very clear. So PC places a lower weight on prices of gasoline and residential rents and focuses on the nation as a whole rather than just focusing on urban areas. The other key difference is that the PCE price index doesn't select a fixed basket of goods. It can chop and change to decide whatever it wants to measure compared to the CPI. What I mean by that, as an example, say the CPI focuses on chicken prices, and in reality, you have people that are actually buying more beef. The PC price index could focus on beef prices rather than chicken prices instead. Then, how does it affect the markets? Usually, with a stronger than expected inflation print, it will tend to strengthen the currency as it shows that the economy is growing. But also in this certain scenario that we have with the Federal Reserve and their rate hiking path, which is now done, presumably, unless they decide to deliver a surprise at the meeting tomorrow, then usually high inflation print will lead to a stronger strong and bullish reaction from the dollar. For the stock market, the inverse happens. If you do get stronger than expected inflation, stocks and stock indexes will see a bearish reaction in anticipation of higher rates or rates staying higher for longer. And there's also the repricing aspect as well that you have of traders who are betting that the central bank is going to cut rates next year, maybe rather than in May. Now it was March before the NFP report. They might push that back even further depending on how inflation plays out. Bond yields tend to see a higher move or bullish reaction. Again, it's the same reason for the dollar. If the Federal Reserve views inflation is higher than what they had previously seen, then they may stay with their rates where they are for longer. And also in turn, you'd see the bond prices seeing move towards the downside. So the basic principle that the bond market works, if bond yields go higher, bond prices go lower. One of the reasons is to attract investors to invest into government debt, hence the price goes lower and the yields go higher to make it more attractive. And the other reason is pricing in the Federal Reserve either being tighter with their monetary policy or keeping things unchanged for longer rather than pivoting sooner. So the previous report that we had in November covering the October report, so the core data had seen increases in rent, owner's equivalent rent, motor vehicle insurance, medical care, recreation, and personal care. There were declines in lodgings away from home, used cars and trucks, communication, and airline fares. And then where is the economy at the moment? An overall gauge of what's going on. So you had, as said last week on Friday, you had non-farm payrolls, which came in slightly stronger than expected. And as said, you had seen repricing of what the Federal Reserve will do next year in regards to their Fed rate cut path when they do decide to pivot. Unemployment rate was at 3.7% compared to 3.9%. Average earnings at 4% compared to 4.1%. Employment cost ticked up to 1.1% compared to 1%. The PC price index and the core data ticked lower as well. ISM manufacturing prices paid ticked higher to 49.9. The services prices paid also had also seen a decline at 58.3. Productivity rose to 5.2%. Import data had seen weaker import prices for the month. PPI and core PPI data had seen declines as well. Remember, PPI is going to be coming out this week as well. So that really isn't going to have a huge amount of influence on the Federal Reserve's their path that they're currently on at the moment. But for traders, it's still an inflationary measure that hasn't garnered as much attention. It doesn't garner as much attention as it did earlier on in the year, but still an important release to keep in mind. Then if we keep going then, so we had triggers then for the economic release. What do economists expect for the high and lows? So the month on month, they see a high estimate of 0.3% and a low of minus 0.1%. For the year on year, with a high estimate of 3.3% and a low of 3%. Core month on month with a high of 0.4% and a low of minus 0.1%. And then the core year on year with a high estimate of 4.2% and a low of 3.9%. Now, bearing in mind, with the last inflation print, if you have had, I did see some comments asking about the document. Yes, as Natty has rightly stated, you do get that in an email on a Monday morning, if you subscribe to the MACROACE mailing list. But if you'd seen the DVA ranges and deviations Google Sheet or the Excel sheet today or whenever you had received that email, you would have seen for the last print that inflation did decline, but by 0.1% on all of the figures. Now, there was an initial, what we'd seen either just before the figures had come out, there was like an initial pop, or and then the markets there was an initial move towards the downside on the stock indexes, but then very quickly they moved towards the upside. So 0.1% deviations for the economic release, for all the releases today for CPI are still going to be important, whether it's higher or lower. But I think we can't put out the idea that if inflation does tick higher by 0.1% and it's also higher than the previous figure, then that could mean you still may get a very strong reaction. Or the other scenario is if inflation does tick higher than forecasted in all the figures or most of the figures, then that could also still lead to a strong bearish reaction from the stock market and a positive reaction from the dollar. Because if the Federal Reserve is expecting the disinflation to have if they're expecting a steady amount of disinflation, but you do see little bumps in the road here and there, although they have said that they are data dependent, you could still see repricing from traders expecting that the Federal Reserve might be nudged in the direction of putting off rate cuts further down the line, rather than what they're currently pricing in, which is for May at the moment. You got an email but no response. Did you? Where did you email? Strange. Okay, send me. Okay, so you guys can send me an email to Tony at FinancialJuice, and I'll get you guys sorted out with it here. Have you? I mean, I did send it out yesterday in the morning. I'll double check your emails, but yeah, send your emails to my email there. I'll have a little double check if you're on the list or not. If you aren't on the list, I'll add you to it. And if you are, then that's something I'm not sure how I'm going to be able to check. That'll be something that might be on your side. Also, sometimes if you are, let's say if you're in your workplace, your organization might have a system where they might not be allowing emails from any unknown locations. But yeah, okay, so let's get back to the prep. I'll deal with any issues that you might have, or talk about any issues you might have afterwards. So those were the triggers. Sentiment and views. So sentiment from the RBC, they say that they think the market is not right to expect a rate hike in December, but too many rate cuts are discounted next year in the market. You have UBS saying that the US economic data will need to walk a fine line in the coming months to sustain the recent rally, while they expect stocks to sustain recent gains and advance mostly higher next year. Equity markets are already pricing in plenty of good news. So this is what I mean by if inflation does come in higher than expected, whether it be by 0.1% difference on all the figures, that could be enough to upset the markets for them to then reprice when the Federal Reserve may deliver their rate cuts. They could push it further out from May, possibly back to June or July, what they had previously priced in for the last two or 3 months from the Federal Reserve. So that's something just to keep in the back of your mind as to how the markets are feeling at the moment, that inflation is continuing to go down. Job numbers are strong, but they weren't as strong as they were in the past, and consumer spending is still quite decent. So there isn't anything that's going to upset them as of yet. So CPI print today could do that. Citi CEO Fraser said that a recession could result because of factors including persistent inflation in services, rising debt levels, a slowdown in global growth, and 2 major conflicts in Europe and the Middle East. Bank of America's CEO Moynihan suggested that the Fed is in the midst of pulling off a soft landing. That is getting inflation under control without a significant spike in the unemployment rate. So we've seen the unemployment rate went down in the last report, but that's just one report. So things are going well so far, and that's what the current sentiment is that the Federal Reserve from Moynihan is trying to pull off a soft landing. There haven't been any worries from economic indicators as of yet to say that they're not going to be able to pull off a soft landing. But of course, it does take a year for interest rates to take effect. So we've already gone. We're nearly towards that mile where the central bank, where the Federal Reserve's interest rates are supposedly supposed to take a stronger effect on the economy. Things are looking okay so far. Goldman Sachs, they said that their economists expect the Federal Reserve to start cutting rates in the second half of 2024 and forecast growth with less inflation, which should be supportive for markets, particularly large cap stocks as well. So there's been a decent image that's been painted for the US economy so far. But again, as stated, the key point the key comment to note is from UBS, is that if the markets are already pricing in good news, anything that goes against that is going to and then turn that sentiment sour, is what I take from that. But that's not to say that even if you do get 1.1% inflation tick higher in one of the readings, that could be the case. But if markets are already optimistic, then remember, if the markets price in a certain figure or an amount, whatever it may be they price in, and whatever deviates away from that pricing in can cause shock. It can cause volatility from the surprise data that traders would see. Then the Fed and government, so you had Fed's Powell said the inflation is still well above target, but is well above target, but is moving in the right direction. He also said that the Fed would raise rates again if needed to lower inflation, but it's premature to say monetary policy is restrictive enough. So that was comments from Powell on December 1st. Fed Scoresby on the same day said the inflation is coming down exactly as they wanted. And if inflation is not on the path to 2%, and even the unemployment rate is going up, they would not stop tightening. Then Fed's Williams said that he noted the significant decline in inflation, and also added that if inflation pressures persist, the Fed could hike again. So again, if this inflation print does see a higher than expected figure, and in particular, from the Fed's point of view, if it is higher than the previous figure, that would definitely be a cause for concern that the Federal Reserve might not have done enough to bring down inflation. Okay, and carrying on, we have market pricing then. So according to the FedWatch tool, so while money markets have almost fully priced in rate hike pause in the upcoming meeting, bets of rate cut next year have been seeping in, with traders seeing a 40% chance, a 40.2% chance of at least a 25 base point cut in March 2024 and a 50% chance in May. And then Fed swaps post the last CPI, Fed data swaps priced in the first 25 base points of cuts for June versus July previously. And then December 8th, Fed swaps price in less easing in 2024 after the jobs report. So that's where it went from March back to May again. So this is the last reaction from CPI. I wasn't here actually for the last CPI report. I was quite poorly. So, but yes, back in action, of course. But here was the last reaction. You can see that there was on the S&P 500, the Dixie, okay, that there was a little bit of a drop there as the data had come out, and then a whoosh, flash right back towards, and then a flash towards the upside instead. Okay, so we've got about 10 minutes left. So just to kind of make it clear, if you do get figures if you do get remember all the inflation prints, if all the inflation figures are higher than expected, then you would expect potentially a bearish reaction from the S&P 500 or the stock indexes, a positive reaction from the dollar. And on the flip side, if you do get inflation that is lower than what is forecasted, then you probably would get the inverse of the other side. So you'd see the S&P 500 seeing a move towards seeing a bullish reaction, the dollar seeing a bearish reaction. Again, it's the data that is, if the data is more, let's say, positive for the stock market, i.e. inflation is headed lower, then that's a good news that the Fed's goal, the Fed's job, the Fed is doing their job to bring about disinflation. It's going nice and smoothly. There aren't any jolts or little jumps here or there, or bumps. But if you do see a release where inflation does go higher, whether it be by 0.1%, then that could, as said earlier on, that could lead to traders repricing their expectations for the Federal Reserve into 2024. So let's go to the deviations sheet. Let's get out of this here. Let's grab it up and see what the last market reaction was like. Okay. All right, here we go. So let's get CPI up on here. Right. So here we have with the CPI data last time round. You can see, as said, there was a 0.1% deviation on all of the figures. There was an initial move towards the downside on the S&P 5 on the stock indexes, as actually there was initial movements before the candles formed their decision and then carried on in the direction that they were going in. So just kind of make everyone aware of what this means. So again, the deviations sheet shows you how much the market has reacted to a set of economic releases or an economic release in the past. And this first figure here, hopefully you can see the figure that I've highlighted. This first figure here shows you the initial market reaction, okay, going to the wick of the candle. In this case, there was a little bit of a dip and then a move towards the upside, okay. All right. The figure in brackets, the figure in brackets here shows you the movement 10 minutes after the release has come out, going to the end of the candle. I always like to try and capture the initial move from the markets. And then here in the light blue or the dark blue bracket that you can see here that I've highlighted, that represents the move 10 minutes after the 30 minutes after the economic release has come out. So this is quite useful to kind of understand what kind of deviations could you be looking for. How is the market going to react depending on what the figures are, and you get a good sense of in the past how the markets have reacted to CPI. But you can tell overall that the reactions have become smaller to the CPI print as the Federal Reserve had reached their goal, was reaching their goal of 2% ever more, and that the idea of another rate hike, or the idea that the Federal Reserve is getting towards their rate hiking cycle or ending their rate hiking cycle, becomes stronger, and then the markets look for the opposite side. They're looking for the Federal Reserve to pivot, and if the Federal Reserve is still focused on inflation, markets will be looking for inflation to continue heading lower to confirm traders' bets that the Federal Reserve could cut rates in May, or maybe even sooner, depending on how inflation plays out. So you might get a lot of choppy action, but this is also another scenario too, is where you might get what we have seen in the past, where sometimes the data is a bit mixed. You can see here back on the 14th of March, where you had only seen one bit of data that had seen a tick up, and the initial market reaction was very choppy. So you can see here, so the first candle, okay, had seen 149 ticks down, then 49 ticks up, and then after about 10 minutes of trading, it was down by 34 ticks. So that was where it was quite choppy. So ideally, you're looking for all the bits of data to be heading in one direction, whether it be up or down, okay, to give you a much better chance of within the market, rather than having choppy bits of data together, which will then mean that the markets might be more confused, and you put yourself in a more dangerous position. Of course, you know, we all know it's dangerous, but you kind of you're giving yourself a bit more prep, as much prep as you can within the markets and how they could play out. Of course, I'm not going to know how much the S&P is going to move, or whether it is going to go down or up, but historically, from what we've seen, this is how the markets have reacted to the inflation print. Whenever inflation goes lower in this cycle of the Federal Reserve, you see a more positive bullish reaction from the stock market and a negative reaction from the dollar, and vice versa, just historically from what we've seen from the past data. Okay, we've got about 3 minutes. Let me put in the link again to the MACROACE mailing list. If you do have any issues, if you don't receive an email Monday, best thing to do is, what's going on here? What is that? Okay, I think that might be. that's a link to the mailing list. Now remember, with the mailing list, not only do you get access to the Excel sheet for the deviations and ranges, but you also get a short summary of what to expect for the week ahead in Europe, Asia, and the US. And when I say short summary, I really mean short summary. There's not a lot of detail there. It's more to act as a refresher of what happened, or what to expect for the week ahead, what's happened previously, if there's any news to highlight, and the links to the live streams as well in one place. Okay, so let's get TICKSTRIKE up and running and set. Okay. Okay. All right, so we'll be looking, we've got 1 minute now to the data. Okay. I am going to go quiet. So I'm going to go quiet for a little bit. Okay, so the data, everything else was in line with expectations. The only downside, the only figure that's seen a movement towards the upside was the CPI month on month at spot 1%. So if we're looking at the inflation figures overall compared to the prior release, so you can see the CPI year on year had seen a decline compared to the prior release to 3.1% compared to the prior 3.2%. Looking at these markets, so as I said, did see that whipsaw there initially, but now seeing that movement towards the upside on the S&P 500. Let's see what else we have here. It's quite mixed, really, is the market reaction. Well, that was what it initially was. So let's see what else we got here. Let's do some measurements. So let's go from what the initial market reaction that we've seen was. Okay, so it's about 39 down first, and then that candle went up to about 26 ticks. Okay, so not as big as reaction as we'd seen last time around. So as we said, the more prints we get, the weaker these reactions are becoming. But with this data, everything was in line with expectation, and only the month on month was higher than expected. But even then, yeah, got a whipsaw reaction that wasn't that strong. Let's look at the dollar yen. We will also have a look at gold as well. So it's about, 48.5 pips towards the upside initially. And then 19 pips down after that data had on that initial reaction. Okay, so that concludes the MACROACE live stream for this event. Tomorrow we have the FMC rate decision. So we have 24 fingers said, "Sir, when dump?" Dude, no idea when that might happen. That I will leave down to you. To see how the market could react. But yeah, so that concludes the MACROACE live stream for this event. I hope you found this information useful. If you have, don't forget to give the video a like, subscribe to the channel, share it with your fellow friends and traders. As I said, if you found the information useful. Tomorrow, I said, we have the FMC rate decision, and I'll provide you with the link for that now, so you guys have access to it. Where are we? Come on, baby. Okay, here we go. Okay, there we are. There's a link for tomorrow for the FMC rate decision. So that'll be about an hour's worth of prep that I'll be covering, because it's the final rate. It's the final rate decision from the Fed for the year, and now that inflation, well, it didn't really give us a clean way forward for the Fed. Still, it's quite useful to kind of understand what the Federal Reserve could do at the upcoming rate decision. So, one other thing to note as well with FinancialJuice. So with FinancialJuice, you have your live real-time voice and text service here. Let me just move this out of the way. So with FinancialJuice, we have a live real-time voice and text service, which we deliver global news to you, as said, live in real time, keeping up to date with what's going on in the markets, if there has been any news or if there hasn't been any news. And also giving you your live voice feed here on the right hand side. You can see that I've selected that there. Okay. Again, that's all in live in real time. You have your text feed here, also live in real time as well, and the economic calendar on the left hand side here, just so you can keep up to date with what to expect for the week ahead. And as said, so if you're day trading and you might see a move in the markets, and you're not sure of why the markets have moved in a certain direction, there may have been a headline that yeah, I see that. There may have been a headline that could have moved the markets. Okay. So yeah, as I was saying, you have your live voice and text feed all in one place to keep up to date with what's going on within the world, what's going on within the markets, all in one place. Now you can subscribe to FinancialJuice. Okay, you can have a go using the free version of FinancialJuice. The free version is delayed. It does have adverts running, and as said, all the site is delayed, so you don't get the full use out of the Pro version. You don't get the full use out of that version compared to the Pro version. But let's say it's your first time coming across a live voice and text feed, and you don't know how it could be used in your day trading. Okay, this site, this newsfeed is made for day traders. If you're not sure, then have a little play with the free version. Okay, even if there are ads, or if there's a little bit of a delay to the feed, it's still going to be useful for you to understand whether or not it will fit into your trading pattern. If it's another tool that you can add to your arsenal, if it works, then great. You can still, continue using the light version, and then when you're ready, you can go to the Pro version of FinancialJuice. So if you see this in the left-hand corner where I'm kind of clicking the button, there would be a button that says Go Pro. First of all, if you're going straight to the FinancialJuice Pro version, just make sure that you have an account on FinancialJuice first with your login details, and that you've verified your email from your email. Once you've verified it, then select your subscription that you want. And then once you've selected your subscription, then just log out and then log back in, and you should have access to this beautiful site here with a beautiful feed all in one place with your news and economic data. One of the things to make sure is, if you are using the site, make sure to don't put any VPNs on it. Make sure you have your news, make sure you have your sound and notifications on, or from Google Chrome or from your website browser settings, just so then you get the best experience that you can from FinancialJuice. Okay, so that's FinancialJuice there. I said the link has been provided for you to sign up to it. That's a link to the free version of the site. And then finally with TICKSTRIKE. So if you've never come across TICKSTRIKE before, well, to explain it to you, TICKSTRIKE allows you to listen into order flow within the markets. Or another way to put it is, how strong is the buying or selling momentum? And it shows you visually and audibly as well. And what I mean by visually and audibly is, here we have our tickers. So if I just bring up gold here, so this ticker box representing gold, this negative figure shows you the selling momentum, and then the positive figure, or the plus symbol with the figure, will show you the buying momentum. So this number, okay, this represents the level of sensitivity, and how much and how often will TICKSTRIKE give you a visual or audio alert, or both. Okay, so 1 is the most sensitive to market reactions. So when there's a lot of buying or selling that occurs within that asset that you're looking at, then TICKSTRIKE will give you a visual. Excuse me. When there's a little bit of buying or selling that occurs, TICKSTRIKE will give you a visual and audio alert on that ticker there. Now, the higher the number that goes, the less sensitive that ticker becomes. So only when there's a big amount of buying or selling momentum that is occurring will TICKSTRIKE give you a visual and audio alert. Of course, you can chop and change that to whatever you want, whatever works for you, whichever way we want to go with it. And you can do that not just on Forex. You can also do it on crypto, stocks, futures, your ETFs and ETNs, and your internals such as the VIX index and ADD as well. You can also use TICKSTRIKE, or look at those assets on TICKSTRIKE as well. So this is a link to the Pro version, or the free version of TICKSTRIKE. Now, bearing in mind, again, it's another tool for day traders to be able to use, to be able to either manage their risk, capitalize on potential opportunities that they might see from the markets if they see a lot of buying, selling momentum, or whatever it may be that they see. But if you're a scalper, if you're scalping the markets, there's another tool that's been added to TICKSTRIKE, and it's the lightning bolt. This lightning bolt. So remember I said 1 is the most sensitive to market reactions. The lightning bolt goes 15 levels below 1. so minus 15. So then it becomes uber sensitive to all the market reactions that are going on. You can see here on gold, you can see where there's a little bit of buying or selling that's going on, that TICKSTRIKE will pick up on that. All those little bits that are occurring. So again, if you're scalping the markets and that's your thing, then great. Of course, same thing, you can chop and change between how far you want to go from, let's say, minus 15 to all the way back to, let's say, level 1. You can chop and change that with whatever level suits you. Personally, I don't use the lightning bolt version of TICKSTRIKE. That's not my style of trading. But if it is for you, then definitely go for it. Because for me, it's a bit too crazy looking at what's going on here for me to be able to use it myself. And that's me being honest. Okay, so of course you can turn it off there. And I'm going to stick mine back to where you usually keep it. Okay. So that's TICKSTRIKE there. Now, if you don't want to, if you're not ready to jump on to the pro version of TICKSTRIKE, then on the news feed, another feature that we have on the site as well, regardless of being light or pro, you have the free version of TICKSTRIKE, which is limited to the 4 asset classes: stock indexes, currencies, commodities, and crypto. And the level of sensitivity is also restricted as well, which you can't chop and change. But again, if you want to get used to how to use TICKSTRIKE, then you have the basic version that is there for you to have a little look at, or the restricted version. And if it's something that works for you, again, when you're ready, you can use the link that I've put in the chat there, which gives you a 7-day free trial of TICKSTRIKE. So you can do your free trial of your free trial before you try the pro version. And then, as I said, when you're ready, go for the pro version. Okay? All right, I'm turning that off because I have a lot of sounds coming through my ears, and that's enough for me. Okay, thank you very much, ladies and gents. Anyone who has issues with their MACROACE mailing list, as I said, send me an email to tony@financialjuice.com. I did put it in the chat there for you. It's the first link that I put in the chat, actually, to my email address. I'll have a little check if you've had issues in the past before. And as said, Monday is when I send out the emails for the week ahead, which will then give you the link to the ranges and deviations. Okay, thank you very much, ladies and gents. Enjoy the rest of your day. A not so great inflation print. When I say that, there were no clear deviations from the forecast figures. But yeah, enjoy the rest of your day, and I'll see you guys tomorrow for the FOMC at 1 p.m. Eastern Time.